I've been seeing homeowners with solid incomes get blindsided by their renewal letters that they never thought would even matter. And it's something that almost everyone is missing. Most homeowners, they have no idea what's about to hit them. But when it does, it could mean hundreds of dollars more each and every month, just like that. So, you're not hearing about this from the banks, and you're definitely not seeing it in the headlines, at least not yet. But over the next couple of years, there's a massive wave of mortgage renewals that are coming. And if you locked into one of those ultra low rates around 2020 or 2021, your monthly payment, it could jump by 10 or 15% or even 20%. And that's not a guess. That's from the Bank of Canada, which estimates that by 2026, almost 60% of mortgages will have renewed. And many will face monthly payment increases of 10% or more. And people with 5-year fixed rate mortgages, well, you could be hit with 15 to 20% payment hikes. And here's the thing, you don't have to move. You don't need to refinance or upgrade to make this happen. This is the same mortgage, and it's quietly resetting behind the scenes. And, we're all watching the headlines about inflation, interest rates, and the Bank of Canada's next move. But the real shift, it's happening under the surface, and it's coming very fast. And look, if you own a home right now, this isn't about panic, okay? It's about being smart right now so that you don't have to be reactive later. So let me just walk you through what's coming down the line and who's most at risk and what smart homeowners are doing right now to get ahead of it all before that shockwave actually hits. So let's start off with the scale of what's actually coming. Now, according to the Bank of Canada, by the end of 2026, approximately 60% of Canadian mortgages will be due for renewal. Now, a large chunk of those, they were locked in between 2020 and 2021, when the rates were as low as 1.5% to 2%. Now, of course, fast forward to today, and here's where things get really serious. Most discounted 5-year fixed rates right now, they're sitting between 4.5 and 5%, depending on that lender and how strong your application is. But if you're looking at posted rates from the big 5 banks, well, those are sitting anywhere from 6 to 6.5%. So yeah, even at the lower end, that's 2 to 3 times higher than what people were paying just a few years ago. So the math, it's brutal. And I'm going to break it all down for you in a minute. But first, listen, I just spoke with a couple in Burnaby, 2 kids working full time, both of them. And they bought back in 2022. They locked in at 1.89%. Their early renewal notice, well, it just came in. And their payment, well, it's set to jump by over $680 per month. $680 per month. Now we're talking the same house, the same mortgage, just a new rate. And, they said to me that they thought that they had more time and, they didn't think that it was going to be this bad. And that's the trap right there. When everything feels fine now, it's really easy for people to put it off until it isn't. It's like driving with the check engine light on, right? You tell yourself you're going to deal with it later, but then that one day, the car doesn't start. And now it becomes a problem. And so, most people, they think that a renewal, it just means a slightly higher payment, maybe a couple of $100 or more. But going from a 2% rate to a 6% rate on a big mortgage, that is not small. And that's not tightening the budget territory, guys. That's restructuring your lifestyle kind of territory. And that's what makes this so very dangerous. It's quiet until it's urgent. That kind of payment shock, it's hard enough on its own. But what happens when thousands of people face that at the very same time? Even if a small fraction of those people are forced to sell, we could see inventory climb even more than what it already is. And when supply goes up faster than demand, well, prices feel it. And don't misunderstand me here. I'm not saying this is a crash prediction, right? It's more of a domino warning. And in a second, I want to show you a dead simple way that you can stress test your very own mortgage. But first, let's take a look at what's happening below the surface. The 2022 rate spike, that was the earthquake, right? Now, the renewal wave, that's like the aftershock. It's going to be slower, less dramatic, but it's going to shake budgets and possibly the entire Vancouver market all over again. I mean, looking at the math, let's say that you bought a $900,000 home in 2020 and you put 20% down. That would be a $720,000 mortgage at 1.89%, or a monthly payment of around $2,800. But now you're renewing at 5.5%, which would mean you're looking at over a $4,000 per month payment. Same home, same income, but suddenly the monthly payment is now $1,200 higher. And that kind of jump, I mean, it hits hard, especially when you're not ready for it. And I'm seeing how differently this plays out depending on when people take action. So for example, two families, both solid incomes, both coming up for renewal, but totally different outcomes. So the first clients, they started planning 6 months early, right? We went through all of the options. We stretched out their amortization a little bit, and we locked in a new rate before things tightened up. So their monthly payment, it only went up $250. So that's manageable. I mean, no huge panic there. But then the other clients, they waited until the last minute, about 2 weeks before their renewal. So there was no prep, no leverage, no lender flexibility. And now they're staring down a $700 per month jump, and they're scrambling to figure out what their next steps are going to be. So guys, planning ahead, it doesn't just save you money. It also gives you breathing room. While waiting, it can cost you both. And to be clear, it's not that people are lazy either, okay? It's just basic human psychology. We tend to avoid thinking about those things that don't appear to be urgent right now. And for many people, they value comfort today more than protecting themselves tomorrow. And the banks, they know this. And that's why they quietly slide those renewal offers in, hoping that you're going to sign them without asking questions. It's easier for them if you don't dig in too deep. But here's the thing. And, it's not just your mortgage that's getting more expensive. Let's not forget that property taxes are up. Home insurance premiums, they're also rising across British Columbia. There's strata fees, those are climbing due to inflation and, building maintenance backlog, all of that kind of stuff. So yeah, your mortgage might go up by $500. But once you stack everything, your taxes, your insurance, your strata, your total monthly housing costs, they could easily jump $800 to $1,000 per month. And it's not just homeowners that are feeling the pinch, right? A lot of investors, they locked in low, they ran tight margins, and now, they're underwater. And many are now cash flow negative. And I'm talking like $600 to $1,000 per month on a rental unit. So if they start selling off all of that inventory, that affects everyone, including you, even if you're not planning to sell. So what are smart homeowners doing right now? Well, first of all, they're not waiting for that renewal letter, right? They're calling their lender early, sometimes 6 months out, just to see if they can lock in or negotiate before things get too tight. And then they're also looking at re-amortizing, all right? So stretching out that loan from 20 to maybe 25 or even 30 years to ease the hit. And that, by the way, doesn't need to be forever. It can be just for now, right? And then some people, they're blending their rates or they're refinancing, especially if they've built up some equity. And then still others, they're shopping around, they're shopping rates, but with their eyes wide open because, and this is very important, switching lenders, it means that you have to requalify. And that stress test, it can catch a lot of people off guard. So one thing that I recommend that almost every client does is do a do-it-yourself stress test. So you simply need to take your current monthly payment and then add 20% and ask yourself, can you still afford it? Now, if you can't, if not, now is the time to plan, not later, okay? And if the numbers are tight, well, consider selling, but on your terms, not under pressure. By the way, if you are thinking about that, you're going to want to start off with an understanding of what your home is actually worth in today's market. So I'll put a link below this video where you can get a free home valuation. You can start with that. And understand, this doesn't mean that you need to list right now. It's just so that you know what your home is worth while you still have those options. Because if you remember that Burnaby couple that I was telling you about earlier, well, they're still in their home, but only because they saw this coming early. And most people don't. Listen, if you think that real estate in BC is straightforward, think again, because most people, they don't realize that the system is stacked against them until it is too late. So make sure you watch this next video popping up right now, because it could literally save you tens of thousands of dollars. And of course, if you have any questions or you want to chat more about what we talked about today, feel free to reach out. There is a link in the description box below. Otherwise, I will see you on the next video.